Hello everybody, welcome to today's fundamentals. Hello Fedro.
Hello.
What's up in the FX market?
Well, the euro is moving in a downwards trajectory. Now, this could be attributed due to the Fed's interest rate decision that occurred yesterday. Essentially, the Fed remained on pause as was widely expected by market analysts. Yet, what was interesting was Fed Chair Powell's post-conference statements in which he had stated that perhaps there is a possibility that the bank may hike once more, so indicating that there might be some leeway for the bank to hike in the future. So based on those statements, it would appear that markets perceive them as slightly hawkish. So despite the pause, the hawkish remarks made by the Fed chair seem to have provided support for the dollar across the majority of the FX pair, so which is pushing the euro towards lower ground. Now, interestingly though, for the British pound, that appears not to be entirely the case. The British pound is moving in a downward trajectory against the US dollar, yet it could also be attributed to the fact that the BOE's interest rate decision is due to be taken on later on today. So on Monday, the markets were anticipating an approximately 90% probability that the bank would have hiked by 25 basis points. Now, following the lower than expected CPI print that came in during the week, it would appear that the pressure on the Bank of England appears to be easing for them to go for another hike. So what do we mean? Well, essentially means that from that 90% I mentioned before, it's now at roughly 50-50. So 50% for a pause or 50% for a hike. So given this uncertainty in the market, we're seeing that the British pound is moving in a downwards fashion. If the bank hikes by 25 basis points, we might see the British pound gaining on the dollar for the day. If it remains on pause, as is the 50-50% probability, we might see the pound further weakening. What I do think will play a bigger part is the minutes of the meeting, or at least the post-conference speech, which actually does not happen that much often. So it depends on what they're going to be saying. If they're more hawkish, then we might see the pound gaining, but if they're more dovish, the pound moving to lower ground. The Aussie is moving in a downward trajectory. The dollar against the Japanese yen is moving in an upward trajectory. So it's moving in an upward trajectory due to the Fed's interest rate decision, but we're also noting that the BOJ's interest rate decision is due out tomorrow. It is, if I'm not mistaken, a 92% probability for the Bank of Japan to remain on hold at minus 0.10. Yet, what is slightly interesting is there might be some guidance, I'd say, in the comments by BOJ Governor Ueda, which may indicate that the bank is strongly considering abandoning its ultra-loose monetary policy in favor of more traditional, quote-unquote, economic policy, perhaps like by hiking in order to increase interest rates, So that would be interesting. Based on BOJ Governor Ueda's comments, we might either see the JPY moving in an upwards fashion or a downwards fashion. Furthermore, the dollar against the Canadian dollar, the US dollar against the Canadian dollar, so the loonie is moving in an upwards fashion. That could be also attributed to the slight weakening of oil's prices, therefore easing demand for the Canadian dollar, combined with the Fed's interest rate decision, appears to have allowed the greenback to capitalize on a weaker Canadian dollar. We also note that their deliberations for their September meeting were released yesterday. Now, I think that these may have been underreported because the bank did say that monetary policy, their current monetary policy, is not restrictive enough. Yet, based on the weakening on the price of oil and the Fed's interest rate decision yesterday, it appears that those comments have been subdued. Therefore, even if the dollar against the Canadian dollar is moving in upwards fashion for now, I do expect at I assume at their next meeting, the BOC may actually hike by 25 basis points. So therefore, in the long run, we might see some support for the Canadian dollar. The dollar against the Swiss franc is moving in an upwards fashion. So we note that the S&B's interest rate decision actually occurred prior to our live today. Essentially, the markets were expecting a 25 basis point hike, yet the bank remained on pause. Now, this does make in part some sense. The bank's inflation rate is still within their current acceptable levels. But what is interesting was that the bank had expected that inflation would have increased in the future. So this is why we may have expected the hike. But they've remained on pause, which has weakened the Swiss franc.
And how is gold's price been reacting?
Well, given that the US dollar is moving in an upwards fashion and has been gaining across the majority of its pairs, it would also make sense that gold is now more expensive for overseas investors, which may be attributed to gold's moving in a downwards fashion, at least for the day.
And how about the US stock markets?
Once again, attributed to the Fed's interest rate decision, we're seeing that your stock markets are moving in a slightly downwards fashion. An appreciation of the US dollar makes it more expensive for overseas investors and in general to purchase these stocks. Therefore, if it's more expensive, less people may be buying, which is pushing them down.
And oil prices?
Well, as we mentioned for the Canadian dollar, oil prices appear to be moving lower. Interestingly, though, the US EIA report came out yesterday, which implied a tight oil market in the US, which one would have assumed that it may have provided some support for the price of oil. Yet, it appears that on the back of the Fed's interest rate decision, oil has moved in a slightly downwards fashion.
And what's in today's calendar?
Well, in today's calendar, we're noting ECB member Lane is due to speak later on today. So if I'm not mistaken, it's a dinner party with a Q&A session. So what is more interesting for me is the Q&A session where he might be asked questions, and based on how he may reply due to him being the chief economist for the ECB, we may see some movement in the common currency. Furthermore, we're noting that the UK's interest rate decision is due out at 2 p.m. GMT plus 2. What is interesting is the amount of BOE members who are going to be voting for a pause. It's anticipated to increase by 1. So from 1 person voting to 2 people voting for the bank to remain on pause. But based on the 50-50% probability of the bank remaining on pause, it might be even more. Should it be even more, we might see a further weakening of the British pound. We're also noting Turkey's interest rate decision, which is anticipated to support the Turkish lira. Now, based on reports from various media outlets, on the sideline of the UN meeting upon which President Tayyip Erdogan attended earlier this week, we're noting that they maybe have been scouring for investors from Wall Street. Therefore, in order to regain confidence, we may see a further than expected rate hike in order to prove to the financial markets that the bank is truly independent. Furthermore, we're noting the US weekly initial jobless claims were anticipated to come in higher than expected, higher than last time at around 25K, which may support the US dollar. The US really Fed business index, which is anticipated to greatly weaken the US dollar. And finishing off the day is the Eurozone's preliminary consumer confidence, which may weaken the euro. And for tomorrow's Asian session, we're noting New Zealand's trade balance, Australia's Eurobank manufacturing PMI, the preliminary figures, the BOJ's interest rate decision, Japan's CPI, which is anticipated to come in lower than last time, so about 3%, which may further weaken the JPY, and Japan's J-Bunk manufacturing PMI figure, which is the preliminary version.
Great. Thank you, Fedor, for your time, and everyone for watching. Join us after a short break for technical analysis.
Hello and welcome to today's live technical analysis. So starting off with the common currency against the greenback. Following yesterday's Fed's interest rate decision on which they remained on pause, we're seeing a weakening of the euro against the US dollar, as can be seen by this bearish candle. It's broken below our prior support level of 1.0670. Therefore, we're going to be having to readjust our support and resistance levels. So we're going to be switching S1 to R1. Resistance now turned to support. So S1 becomes R1. This slight gain could be from could be a minor retracement following the bearish candle moving lower. We're anticipating that the pair will continue perhaps moving in a downwards fashion. Why? Well, based on the remarks made by Fed Chair Powell during yesterday's statements, yesterday's interest rate decision, essentially, they were hinting that they have one more rate hike in the bag before they're done. Moreover, they also said that there might be less rate cuts than what was previously expected by market participants. So fewer rate cuts is essentially the same story with the ECB, upon which there might be a prolonged period of the current interest rate levels staying at their current levels. So for S3, as we usually do together, we're taking the opening and closing of bullish and bearish candles validated previously. We have two, and then we have it once again. Let's just make sure. There's an old resistance level. So for S3, you have the 1.0315 level. Just come back here, and there we go. R1 is pretty close to R2. Therefore, for a bullish outlook, it would need to break above both R1 and R2, with the next target potentially being the R3 at the 1.0865 level. S2 becomes S1. S3 becomes S2. And then we have S3, 1.0315. Have S1, S2, S3, R1, R2, R3. The narrowing of the Bollinger Bands may imply that it could move in a slightly sideways fashion. For now, we're extending our downwards moving trend line. It's still being validated. This could be simply low market volatility, which is why we're also saying for a bullish outlook, it would need to break above R2 as well, as it could simply break slightly above before moving lower. And the RSI is closing to near 50, implying a neutral market sentiment, yet it is still below. So I'm expecting that this is probably just a small market correction. Moving on to the British pound, we're noting that the Bank of England's interest rate decision is due out later on today. So what we had placed in yesterday as 1.2310, S2 at the 1.22 level, and then 1.204550. S1, S2, S3, and then R1, R2, R3. It is still validating our downwards moving trend line. Moving lower. So a bearish outlook also running along the figure of 30 implies a bearish market sentiment. Now, if we zoom in, we can see that it's already broken below S1. So we're going to be readjusting R1 to this bearish and bullish candle. 1.2420. If you have any questions, feel free to ask in the chat. And for S3, just measure the difference. S3 is at the 1.925 level. Slight widening of the Bollinger Bands imply some market volatility, not too much though, slightly below. Maybe there's a small market correction to the mid-range, validating once again our downwards moving trend line before continuing to move lower. So as we said during the fundamental session, for those of you that were not in watching at the time, excuse me. Essentially, what we're saying is that on Monday, the probability of the Bank of England hiking by 25 basis points was more or less 90%, at least 70. Actually, it was between 70 and 80%. Since then, that has switched to a 50-50 chance for it either to remain on pause or to remain on hike. Or excuse me, for them to hike or to remain on pause. The 50-50 switch from a 25 basis point market expectation that could have been already priced in by the market is potentially one of the reasons leading the British pound to lower ground. Now, the 50-50 is now being adjusted and priced into the market. If the bank hikes by 25 basis points with some hawkish rhetoric, hawkish remarks, I would not be surprised if it breaks above R1 to R2. Now, what I personally believe that the Bank of England will do is they're probably going to hike by 25 basis points. If they're going to be sounding dovish or hawkish after the hike, that I'm not very certain. What I do expect is that the lower than expected CPI may have ease pressure on them to be extremely hawkish. So if they do hike, I expect it to come with some dovish remarks. Yet if they remain on pause, I would expect it to come with some hawkish remarks, essentially balancing it out. For the Fed yesterday, we anticipated a 25 basis point hike. That did not materialize. But we did note that there were potential for some hawkish comments, which actually did occur. You might also be seeing that there is ECB President Lagarde, who is due to speak later on today, and ECB's lane. The reason why I mentioned the ECB lane over the ECB President Christine Lagarde is that the lecture the ECB President is giving, I think, is more structured in terms of the questions she may get asked or the way she might be answered, may be more dictated in terms of organized and structure and avoiding to answer perhaps some hard, quote unquote, questions. Whereas a Q&A, which is more freely and there's more room for a discussion to occur, may reveal something a bit more rather than the lecture given by the ECB president. Dollar against the Japanese yen, moving in an upwards fashion, aiming for the R1 level of 148.73. Validating our upwards moving trend line despite slightly breaking below. RSI still near 70, implying a bullish market sentiment. Now, if the comments made by the BOJ after their interest rate decision, upon which I do expect them to remain on pause at the minus 0.10% level, if they're hawkish which I think they might be, slightly hawkish in terms of perhaps stating that they're taking, as we said yesterday, taking the change in monetary policy a bit more seriously, perhaps abandoning ultra-loose monetary policy, but not at this point. It's simply far too early for that to occur, in my opinion. I think it's going to come in later, perhaps by the end of Q4, perhaps even Q1 2024. So around there, we might see some meaningful change. For now, I think it's just going to remain in the status quo. Yet, if we see some hawkish marks, we might see the Japanese yen gaining. If we see very dovish remarks by the BOJ, if it does reach R3 at some point, I would not be surprised if you see intervention by the central bank, reaching acceptable levels, pushing it back down. For now, though, on a technical and a fundamental basis, I would not be surprised if it breaks above R1 and moves towards R2. The dollar against the Swiss franc moving in upwards fashion on the daily. It's 1, 2, 3, 4, 2, 3, 4, 7 days in a row. It opened lower but closed higher, still in the greens since the beginning of September. Let's clear out our chart, and we're going to be charting this together. So on MT4, simply put, you can right click, objects list, and then we can sort it by description. Voila, clear chart. We're going on to the 4-hour chart. Extreme widening of the Bollinger Bands implies high market volatility. So let's find S1 together. This could be S1, or this could be S1. Personally, I think I'm going to be going with this as S1. Big figure. This is S1. Why? It's the point between the bearish and the bullish candle upon which the pair moved extremely higher. So this would be potentially the first support level for the bears to break. Then this would be my S2. I'm not bringing it at the swing high. I'm giving it some room because if it does break down, I would not be surprised if it breaks down below this as well. So more valid point for S2, in my opinion, is at the 0.8905 level. Let's also place in some text box. Arial, yes. Text, we could place it as S2. Then go, and then we're using green. This could be S2. We could place this as S1. 0. S2, and then for S3. Note the difference between S1 and S2 is nearly 100 pips. So we're giving it enough space for it to move. And let's just make sure it's far too. I'm trying to align this swing high with this bearish and bullish candle. Let's see, make it. Would be slightly higher. So I'm simply going to stay with this swing low. Actually, let's make the support line slightly more clear. There we go. S2, and then text for S3. .8805. Nope. 0.08810. Yes, we're gonna have to keep it at 0.8808 to coincide with the bearish and bullish candle. Otherwise, if it's slightly too high, slightly too low, then we are missing out on this price action here. So we have S1, S2, S3. And then for R1, you can see this at the right hand of your screen. This is where the price action currently is. So this would be my R1 swing high. And then for R2, this would be R2. Why am I placing this here? 0.905. $0.9025. This would be my R2. Yes. Why are we placing R2 at this point? Well, essentially, if I had placed, let's say, resistance at this level here, I would have simply had this swing high. Still valid. Yet, if we move just slightly upwards, you can see there is a strong bearish sentiment. Why am I saying strong bearish sentiment? You can see you can see about 4 candles trying to break above this certain point, but failing it each time. I'm disregarding the wicks as to why. The wicks could have simply taken out individuals who have gone short at around here and had placed their stop loss at perhaps this level. So it's taking liquidity before moving lower. What interests me is where they open and close. If they're all opening and closing at a certain point, that shows that there is a strong support or resistance level, in my opinion. So I'd rather take this point here than this one here. Because if I believe that if it reaches at this point, which is the what? This is the 0.918 5 level, for example. Well, yeah, it is 5. If it reaches that level, I expect it to simply break above, even by a wick, and aim to test resistance at this point. So I think this is a more valid resistance level. So let's just actually place that in our text label. If you're using the wicks, that does not necessarily mean that it is wrong. It is simply a preference. There are some individuals that would rather take, for example, let's just draw, for example, could say, it came up here. This is a support level using this wick here. I, on the other hand, would use this. I'd say I disregard the wick. I take the open and close. Or they could say that this here is a support level. I'd rather take, once again, this point here. So we have R2, and now we're looking for R3, and we've actually deleted our one text label. So for R3, based on the same preconception that we're using before, and we're simply just 86 pips. So I'm in a bit of a dilemma. I could place R3 here, taking this swing high, validated by the wick, or placed here. I'm going to be placing at the initial point. It's coinciding with multiple bullish and bearish candles in comparison to the other one, which was simply at just the wick. 0.9295. There we go. So we now have R1, R2, R3, and S1, S2, and S3. Let's just bring in again the text labels. R3. This is R3, and then for R1, at the 0.99105 level. So we're maintaining a bullish outlook for the dollar against the Swiss franc. RSI above 70 might be slightly overbought, yes, but it still implies a bullish market sentiment. Upwards moving trend line as well, aiming for R1. If it comes back down to test support at S1 before moving higher, I would not switch to a bearish outlook. For a bearish outlook, it would need to break above our upwards moving trend line and then move towards S2. For a bullish outlook, breaking above R1, moving towards R2. We're going to be looking at gold as well. It broke below our upwards moving channel, aiming for S1 at the 1,920 level. Switching from the 50 RSI towards the 30 implies a switch from a bullish to a bearish market sentiment. It's breaking below the mid-range of the Bollinger Bands as well. So for the precious metal, I'm anticipating a bearish outlook up to S2 at the 1,902.50 level. For a bullish outlook, it would need to break above R1 and move towards R2. We're going to be looking at oil as well. It's respected R1, I could say, moving towards S1 at the 87.50 figure. For oil, as you can see, it's moving in a downward trajectory. The RSI is near 30, not yet at 30, but since it's below the mid-range of the Bollinger Bands and has broken below the upwards moving trend line, I would not be surprised if it breaks below S1 and moves towards S2. So for oil, we're maintaining a bearish outlook. Interestingly, for oil, the US EIA report came out yesterday, which implied a tight oil market in the US. In theory, this should have supported the price of oil, yet it appears that the Fed's hike is alleviating pressures, therefore, making the dollar much more expensive. And since WTI cash is bought using the US dollar, may be more expensive, moving towards lower ground. So, maintaining a bearish outlook. We should also do the dollar against the Turkish lira. Against the Turkish lira will be an interesting one. So during the fundamentals, we stated that they're looking for investors. They want to prove that the central bank is independent from the government in order to attract FDI. So let's see. Dollar Turkish lira. There we go. There. Dollar Turkish lira. As we said, the upwards moving channel is very easily broken. Why? It's actually been respected. Okay, correction. Dollar moving higher. The dollar against the Turkish lira is extremely volatile. Just look at this bearish candle. It's insane. It's moving towards 50. Now, if I was the Turkish central bank and I wanted to convince investors that it's actually independent, instead of the 5% hike we're anticipating, I'd go 10. I wouldn't hike to 30%, I'd hike to 35. Slightly bit too much, but it's not over-exaggerated. That way I could prove that we're hiking, we're independent, we're taking at data, we're taking this seriously, therefore bring money into our economy. And using that, I would expect that the Turkish lira will may appreciate against the US dollar following the central bank's interest rate decision. Now, if they come in lower than the 5% that the markets are expecting, breaking immediately above R1, moving towards R2. If they hike further than expected, moving towards S2 almost instantly. Just look at this move from 12. Let's say it reaches somewhere around here. It could reach at the $25.5 mark immediately and then move lower towards S2. So we're maintaining, from a technical level, you could say it's moving in upwards fashion, but from a fundamental level, if Turkey's intentions are what they seem, then we might see the pair moving in a downwards fashion. So breaking below S1, moving towards S2. Now, what can we look at? We can look at Airbus. Excuse me. Airbus is moving towards, it's broken below S3. There are reports that, if you remember the last time we looked at Airbus, it was the fact that there was a UK-based company was selling fake parts to Boeing, for Boeing and Airbus planes. There's now an investigation, as was expected, into the company. if we begin to see some recalls of planes, this could go much lower, much lower. Or I'm saying, yeah, but this is not an airline company. Yeah, but they're providing the planes. If the parts being sold for their planes have issues in them, then it would make sense that the manufacturer is going to be taking the hit as well, not simply the airline carriers such as British Airways, Lufthansa, etc., etc. So this is S1, R1, R2, R3. I could even bring this slightly lower. I'm at 33.85. Actually, on an hour. Moving lower and lower. Makes sense. If I was being sold fake parts as well, I would be concerned about stock price too. 1.25.15 for S1. $122.35. We're still maintaining a bearish outlook for the company because as this investigation continues, we're probably going to find something that either went wrong or, well, we might find something that went wrong, or at least if they're forced to recall some planes, yeah, then which is likely considering that the parts were made from using bogus certificates as well. So there is a possibility that this might occur, which could cause disruptions in some flights, planes, and the such way on the manufacturer's stock as well. There we go. So maintaining a bearish outlook for Airbus. And with that, we also note that there's going to be the POE's interest rate decision, Turkey's interest rate decision. The Swiss National Bank remained on pause at 1.75. Therefore, for the rest of the day, I'd be highlighting the Bank of England's interest rate decision. Thank you for watching, and until next time.
And welcome to another IronFX video on an introduction to pips. This time we will focus on the units of everyday trading. And we will start with the smallest unit used, the pip. A pip is an acronym for percentage in point and is actually the smallest unit price movement an exchange rate can make. In other words, a pip refers to the unit we use to calculate the change in value of a currency pair. This is the relative value between two currencies. For example, if the value of the Euro-USD pair moves in from 1.3723 to 1.3724, this means there is an increase of 0.0001 in the exchange rate. This is also referred to as 1 pip. Note that all major currency pairs are priced to the 4th decimal place with the exception of Japanese yen's currency pair that are measured to the 2nd decimal place. Gains and losses are easily calculated based on pips. We just multiply the position size by 0.0001. Let's look at another example. If there is a 10,000 unit mini lot position open and we want to measure the 1 pip movement, we just multiply 10,000 by 0.001. That is 1 pip, which equals $1 per pip. This means that for a position of 10,000 units each time the pair moves by 1 pip, there will be a $1 gain or loss depending on the way it moved. Put simply, if the Euro USD moves 100 pips in our direction, there will be a $100 profit. This calculation works for everyday trade size. Simply multiply the trade size by 0.001 or 0.01 for yen currency pairs. We hope you enjoyed this video. Stay tuned for the next one.
Before we get started, as per usual, a risk warning. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. A disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is strictly prohibited. Okay, so maybe just a brief introduction. I am Melanie and I will be your speaker for today's stop loss strategy webinar. Okay, let's go ahead and get started. So here's our agenda for today. Firstly, we'll talk a bit about how stop loss will affect your risk to reward ratio beyond and before. So if you're wondering what that is, we'll get into that in a little bit. And then how far should your stop loss be, market structure stop loss, Fibonacci stop loss, and then we'll go through a couple of trailing stop loss strategies as well. Okay, but first things first, we'll go through the anatomy of a trade as well as some risk management strategies. So trade management refers to the process of managing open trades in the financial markets to maximize returns and minimize risk. So, of course, the anatomy of a trade contains or consists of the entry, your stop loss orders, as well as your stop profit or take profit orders. And then this is what is part of a risk management series, which we won't go through in detail today. Maybe in future webinars we'll go through these, but for today we're going to focus purely on stop loss, and we'll touch a little bit on trailing stop loss as well. Okay, so firstly, why is it so important to have a trade management strategy. So firstly is to control risk. Trade management strategies such as stop loss orders and position sizing helps traders to limit their potential losses as well as manage their overall risk exposure. Next, maximize profits. So trade management strategies such as take profit orders and trailing stops help traders to lock in your profits and maximize returns. Manage emotions. This is pretty important because the discipline and structure that having a good risk management strategy provides can help traders to stay calm and rational even in volatile markets, which can prevent impulsive decisions driven by fear or greed. Fourth, improve trade efficiency. So when you have a well-defined trade management plan, then you can make faster and more informed decisions and avoid the cost and time of having to constantly monitor and adjust your positions. And lastly, increase consistency. So an effective trade management strategy and risk management techniques helps traders to achieve consistent results over time by reducing the impact of individual losses and maximizing the impact of winning trades. Okay, so let's get into it. So although we're focusing purely on stop losses for today, I do want to touch a little bit on take profit as well. So we'll start off by going through the issue of having a fixed take profit and stop loss. Okay, so we're going to start off with take profit. So let's take a look at this example together. So the red area here shows a strong resistance area because this has two multiple swing highs that line up nicely. So if our trading strategy requires us to have a fixed take profit of 100 pips, then we will place the target beyond this strong resistance area, which you can see here. That's what we did here. Okay, so let's see how this plays out. And you can see that price shot up, but it missed it by a couple of pips before reversing back down. And the reason for this is because price tends to reverse off of big areas of resistance and support. So it might not reach where you place your take profit. Okay, so here we see in an alternative scenario, if we had placed our take profit before the key resistance level, which means just slightly below, we would have got a profitable trade because price would have been nicely touching our take profit. So it's important to look at the charts and then adjust your take profit and stop loss accordingly. So the lesson that we're trying to talk about in this case is to not blindly follow a fixed take profit target just because some forum or education platform tells you to do so. Because you always want to look at your charts and adjust accordingly because each chart is different. Okay, so this is the general idea for stop loss and take profit placement. So this is what we meant earlier by beyond and before. So for a stop loss, we would typically recommend you to place it beyond a major resistance area. So if we're talking about a major support area, this should be support instead of resistance. So if we're talking about a major support area or even a major confluence area using Fibonacci, you want to place your stop loss below it or beyond it. Below would be if it is a support level. And you can see in this case, since it's a resistance area, we'll place it above. So that's what we mean by beyond. So for our take profit, on the other hand, we want to make sure that we place it before. So that means that it's within the charts. So not beyond it, before it. And if we're talking about a major resistance area, then we will want our take profit to be placed just beneath it. Okay, so this is the general idea for a proper stop loss and take profit placement to ensure that you maximize your wins as well as minimize your losses. Okay, we'll go through a couple more examples in the next few slides as well. Okay, sorry about the mess over here, but this is just to recap a little bit about the whole stop loss beyond take profit before concept, but in the context of Fibonacci confluence. So in this case, we're talking about Fib confluence. So stop loss beyond still stays, and you want to place it beyond a key Fibonacci confluence area. So price is attracted to strong areas of Fibonacci confluence. And if your stop loss is right before instead of beyond it, you will most likely get stopped out before the market reverses. So this is one of the most common reasons why people wonder why they got stopped out right when the market starts to reverse. So if we talk about take profit, we mentioned earlier we place it before a key Fibonacci confluence area or major resistance area, so on and so forth. And the reason for this is because when price reaches the Fibonacci confluence area, there is a high chance that it will not be able to go beyond it. And instead of reaching your profit target, it reverses back to your entry, or even worse, your stop loss. So this is one of the reasons why people complain that the market is being manipulated, because they miss their take profit by 1 pip. Okay, so that's the general idea of trade management and where is the proper placement for stop loss as well as your take profit levels. Okay. Here in this case, we are talking about the problem with fixed stop loss. So earlier we talked about the problem with fixed take profit. So now we're talking about stop loss. So here's an example to show this problem. Here we have a support level. You can see 2 swing lows that line up nicely at this support level. Price has bounced off of this support level, and we are expecting it to continue to rise to the swing high resistance over here at the 1931.43. Okay, so our stop loss of 100 pips is fixed at this 1894.75 level at the support level. Okay, so this is what happens instead. Instead of shooting up as we expected it to, it actually reversed off of our entry and then bounced off perfectly. So what we should have done instead was to place our stop loss, which was over here, the green line. Instead of the green line, we should have placed it at the yellow line instead, because we mentioned earlier that you want to place your stop loss slightly beyond a key level of support or resistance, just to allow that space for a reversal or a bounce to take place. Okay, and we can expect this to happen because price often gets attracted to key levels of support or resistance and then reverses off of them. Okay, so now we're going to talk a bit about dynamic stop loss placement. So that's what we talked about in the previous few slides is precisely why dynamic stop loss placement is so important. So if you're wondering what exactly is a dynamic stop loss, it's a trading strategy used to manage risk in which the stop loss level is adjusted dynamically based on market conditions. So the level of the stop loss is continually moved to a more favorable position as the price of an asset moves in the desired direction. So the goal of a dynamic stop loss is to lock in profits while minimizing potential losses. So the placement of the stop loss can be determined by various technical analysis indicators or other market conditions, such as volatility or market trend. So here is our first example. It's to demonstrate dynamic stop loss. Here we have price bouncing nicely off of the support level at 86.721. So it's bouncing off here. We're expecting it to reverse off the entry at this 87.819. That's in line with this 100% Fibonacci projection level. Okay, and then our stop loss is placed at this swing high resistance here. So this is what happens. We're expecting it to reverse off. So it does test this level, this entry level. And the reason for this, for that bit of resistance, extra resistance at the entry, is because you can see earlier we have this 100% Fibonacci projection that lines up nicely with this level. So you can see the resistance and price testing this entry. Next, we have the negative 27.2% Fibonacci expansion, as well as the 61.8 Fibonacci projection that line up nicely. So this is where we decided to place our stop loss. And this is how we use Fibonacci levels as stop losses as well. When you have a couple of levels that line up nicely, we call that a confluence area. And it's even better if you can find a chart indicator or market structure indicator, where basically you look at the chart and you see that, oh, this is a resistance level, and we place a stop loss here. And this stop loss lines up nicely with Fibonacci levels as well, which makes it extra important to take note of. So we see price is testing the 87.819 level at the entry here. So we mentioned earlier that stop loss should be placed beyond the Fibonacci confluence area instead of directly on the area. And we'll show you why in the next slide. So this is a zoomed out version of what we had in the previous slide, but you can see price breaks out of our entry and it hits right towards our stop loss levels. And it's just as we had expected, because this is, as we mentioned earlier, that this area is an important area with the Fibonacci confluence as well as the swing high resistance. So this whole area is a strong area, and its price is attracted to such strong areas of resistance. So we can expect price to be attracted to this area. So what we do is we place our stop loss beyond it. And you can see if I place my stop loss directly on this Fibonacci area instead of beyond it, we would have gotten stopped out. So we're expecting the reversal, and it hits right down to our take profit, which is exactly what it did here. Okay, let me know in the chat if there are any questions throughout the webinar. But I think so far we should be pretty clear on this. So let's take a look at another example. In this case, we have another take profit placement example. So here we're expecting price to bounce off of our entry at the 87.625 level at the pullback. So this is what we call a pullback resistance, because we have a swing low here and price has passed this area here. So before price actually reverses off this area, it's called a pullback, because we are expecting price to pull back to that level or retrace to that level. Okay, so our stop loss is placed at this swing high resistance here, and our take profit is placed at the swing low resistance. And then if we take a look at our Fibonacci, we have the 78.6% Fibonacci retracement that lines up nicely with our entry level. So once again, this is a level for us to take note of. We can expect price to be attracted to this level here. Okay, you can see price moving up this area. Price hit our entry and has reversed off of it nicely. It's now heading towards our take profit. And then we pull out another Fibonacci indicator. In this case, we are using Fibonacci retracement. Okay, this is wrong. It should be Fibonacci projection, because this is our starting point, our middle point, and our ending point. So this is a 78.6% Fibonacci projection. Sorry about that. But the chart is still correct. We have a projection level that lines up nicely with our take profit. So you can see we're expecting price to be attracted to this area because of the swing low resistance, swing low support, as well as this Fibonacci level. So you can see price was attracted to this area. It approached it continued downwards to our take profit, and it touched our take profit just nicely before reversing off of it. So this is one reason why we advise you to place your take profit before it, because if you had placed it even slightly below, you would not have caught this take profit there. Okay, actually even this take profit level is a little bit far, so you have placed it further in on our price chart. Okay, next example, we're looking at a take profit placement again. So even though this is stop loss, but we want to talk about take profit to show you guys how the two line up nicely together. Because even if you have mastered all of the stop loss strategies, if you can't manage to get your trade in a take profit, there's no point to it basically. So here we have firstly a descending trend line, but you can see our price has recently broken out of this descending trend line. So it's giving us a bullish bias. Okay, so after we've established that, we go in with our take profit and stop loss levels, and these we make use of the support and resistance levels here. So our entry is at this pretty significant level, overlap resistance. Overlap just basically means that a bunch of swing lows also line up nicely with a bunch of swing highs, and price has tested this level many times. Then our stop loss level is just at the swing low here, and our take profit is in line with many Fibonacci levels that you can see here. So it's a negative 27.2% Fibonacci expansion, as well as 127.2% Fibonacci extension. So with these two lining up at our take profit level, remember you want to place your take profit before instead of beyond your Fibonacci levels. Okay, in this case, you see we place it above or before it, or beyond it, I mean. And you can see price reversed off of it and we missed our take profit by a few pips. So if we had placed it below instead, it would have nicely hit our take profit before reversing back down to our entry. Okay, so now let's get into the trailing stop loss. So a trailing stop loss is a special type of trade order that moves relative to price fluctuations. So when the price goes up, it will drag the trailing stop loss along with it, but when the price stops going up, the stop loss price remains at the level that it was dragged to. So it's an order type that's designed to lock in profits or limit losses as long as the trade moves favorably. So an automatic trailing stop loss moves according to how price moves favorably, and then a manual trailing stop loss is a moving stop loss level that's based on mechanical indicators. So here's an example of where you place an idea invalidation level. Okay, so here's our first level. This is moving average. Here we have the chandelier SAR. Here the ATR is parabolic ATR as well. Okay, so here is how to use them. Okay, in this case, we are using moving average as our first example. So here we are going in for a sell entry. You can see I've I've indicated this level where we want to enter from is a 1.57891 level. Okay, and this is where price crosses the moving average indicator, and that's my entry. Also note this ascending trend line as well, and price is breaking out of it. So a lot of bearish indicators over here. Okay, so price, or rather we call this a moving average crossover. So once price crosses over price, then we go in for the entry. Price continues moving downwards, and then once price crosses over the moving average again, then our trailing stop loss is triggered. Okay, so it got us out before this happened. So this is the before, this is where you get stopped out. And then this is what happens if you weren't stopped out. Okay. Here we have trendline trailing stop loss. Remember, for a valid trendline, you need at least 3 touches for it to be valid. Here we have 1, 2, 3 over here. Okay, so the same concept on the same chart, we have this trend line with price moving downwards, and once price starts reversing, even though it's reversing, we are not stopped out yet until it hits the trend line, and then we are stopped out. Once again, to prevent us from this eventual upward movement. Okay, so here we have parabolic SAR, trailing stop loss. It's the same concept. We are going in for a sell entry once price changes, or rather once our indicator changes. So it's moving downwards, and then once price hits our parabolic SAR indicator, that's a sign for us to be stopped out. So yeah, that's how the parabolic SAR trailing stop loss works. Okay. Here we have chandelier and ATR trailing stop loss. So it's all on the same chart, just to show you guys how you can use the different indicators as your trailing stop loss, just to help you guys decide when to stop or get out of the trade. So same thing, same sell entry, same chart. So we go in for the sell over here. Once price moves downwards and it hits our indicator once again, then both of these indicators are triggered and you have gotten out of the trade. So it really minimizes your losses that could have resulted if you had allowed price to continue moving upwards. Okay. So here, how we know this is our sell entry, using these two indicators. Basically, when price overlaps over here, as you can see over here, there's another overlap that takes place, and that's why you get stopped out. Okay. So here is an actual example. Here we have the Kiwi dollar, and we are making use of the moving average indicator. So we go in for the sell entry over here when price okay, firstly we have this ascending trend line. So it's moving upwards, and then we go in for a sell entry once price starts moving down. So it hits this ascending trend line as our sign that it's gonna break out of the ascending trend line. Going for the sell entry, we continue, and it hits our take profit. Okay, another indicator is that over here, at this green line that I've indicated here, you can see price cross over our indicator. So that's yet another sign that price is gonna continue downwards, or trend is going to change. Okay. Next example, we have once again a trend line. So trend line going upwards, price breaking out of it, then we're going for our sell entry. So going for our sell entry all the way, we're expecting it to move all the way downwards to our take profit. Okay, so the red and the blue lines, as you can see here, the lines that are not indicated as stop loss, sell entry, and take profit, these are the lines that we are showing you are pretty significant because we have an overlap resistance here. So as I mentioned earlier, an overlap is a swing high and a swing low that line up in the same level. So that's our red line. So remember I mentioned that when we have significant areas of resistance, that we want to place our stop loss beyond it. So that's exactly what we did here. And then as for our take profit, over here I have a big swing low over here. So which is why I place my take profit before it instead of below it over here. Okay. So that's the end of our slides. Now we're going to look at some charts and see if we can implement what we've just learned into actual setups. So let me know in the chats if there are any specific setups that you'd like to see. I think you should be able to let me know in the chat or let me know in the Q&A section. Yep. Okay, I think in the meantime, let's go ahead and just take a look at maybe euro dollar. Okay, if there is any other commodity or currency pair you'd like to see, feel free to let me know in the chat. Okay, so let's get right into it. So we typically like to start on the higher time frames and then work our way down. So here I have on the weekly time frame, we have a pretty bullish, I mean, it looks like price is moving upwards, the general direction. Okay, on our daily as well, we have a ascending trend line. Okay. So both weekly and daily timeframes are giving us pretty bullish trends. Now let's take a look at our 4-hour time frame. Okay, it does look like price is breaking out of the ascending trend line here. Okay, but let's go in with some support and resistance levels. So here's my first resistance, and then my second resistance over here. My first support just here. And my second support here. Okay. So now that we have that, let's go in with our Fibonacci levels. So from here to here, I have a retracement. You can see my 50% retracement lines up, and my okay, even though this 50% lines up nicely with my first resistance, it's no longer valid because you can see price has already broken out of this level. So I'm going to look at the other levels. For retracement, we use these 5 levels: 23.6, 30.2, 50%, 61.8, and 70.6. Okay, and I can see that my 78.6 lines up nicely with my second support. So I'll just keep that. Okay, now let's go in with a Fibonacci projection. Okay, I can see that my 61.8 and my 100% line up nicely. Okay, I think that's all the levels that I have. So now I'm going to go in with some indicators. So the indicators that we like to use are Ichimoku and MACD, because just at one glance, it tells you exactly what the signals are. So price is moving below the Ichimoku cloud on our indicator, giving us a bearish signal. MACD is giving us a pretty bullish signal. Slightly bullish over here. Let's take a look at RSI. Okay, we have this bullish signal. If we take a look at our chart, at our price chart versus our RSI, at the highlighted areas, price has remained at the same level at our first support, whereas on our RSI, it has made a higher high, and in fact, price is moving in this ascending trend line on our RSI. Okay, so I'm gonna go ahead and remove this trend line here, because earlier I mentioned that it could be breaking out of the descending trend line, right? But it also could be an ascending trend line. So this is one of those rare occasions where we have 3 touches on the trend line for both, depending on how you adjust it. Okay, so that's why I waited for all of my other indicators as well as my analysis to be completed before I go in and adjust my trend line. Okay, I'm going to remove my Ichimoku as well because it doesn't support our analysis. So you can see that we have quite a lot of bullish pressure here. So we can expect price. Let me just highlight this area as well. Okay, here. So my first support I mentioned is a pretty significant level with all of the swing highs and swing lows and price testing it many times. But I also have the 61.8 Fibonacci retracement and a 61.8 and let me take a look. Yeah, 61.8 Fibonacci projection. You can see this 3 points over there. So my 61.8 Fibonacci projection lines up nicely with my first support. So I can expect price to reverse off of our first support and within this ascending trend line. Okay, let me know if you guys have any other questions. Okay, if not, I think we can move on to our next chart. Let's go ahead and take a look at gold. Okay, so let's begin by looking at the higher time frames again. We have these 3 swing highs. Price looks like it's moving upwards here. On our daily time frame, price is pretty bullish as well. Okay, this is not a valid trend line, but I think we can all agree price's general trend is upwards. Next, 4 hours time frame. Okay, I have this trend line. Now let's go in with our support and resistance levels. Okay, so I have a support level here. Next, I have a resistance level here. But I'm not going to label this as my first resistance. I'm just going to call it an intermediate resistance because it's really close to where price is at currently. So I just want to keep that in mind. Okay, now. Okay, I try to pull it back as far as I can, but I'm cutting too many candlesticks over here. Okay, next, our second resistance here. Okay. So now let's go in with our Fibonacci levels again. So same thing for a retracement. I use these 5 levels. Okay, and I can see my 38.2 lines up. and my 78.6 as well. So I'm just going to keep those two. Okay, next I'm going in with a Fibonacci projection. So for Fibonacci projection, we use these three levels, 100, 78.6, and 61.8. And okay, my 78.6 lines up with my first resistance. Okay, my 78.6 also lines up with my second resistance. Yeah, I think that's about it. Okay, now let's go in with some indicators again. So price is moving below the Ichimoku cloud. It's also giving us bearish on our MACD. Now let's take a look at RSI. Okay, once again, we have a pretty bullish divergence again. Okay, now let me take a look at stochastic as well. Okay, I'm gonna go ahead and remove our ascending trend line. Okay, here we have a descending trend line, and on our stochastic, we also have a descending trend line here. Okay, so I'm going to move my RSI, and 3 out of the 4 indicators that we've used tell us that it is a descending or it's a bearish momentum. Okay, so in this case, I can expect price to continue moving upwards towards this intermediate resistance, but there will be some resistance over here because of all of the downward pressure from the indicators as well as the descending trend line and also this 38.2 Fibonacci retracement. And as I mentioned earlier, this is a pullback area, resistance. So I can expect price to have some resistance here and maybe reverse off of it and head back towards our first support. Okay. So in this case, our take profit would then be at our first support, entry at our intermediate resistance, and then I'll place my first resistance as my stop loss. And as I mentioned earlier, I want to place it above, maybe slightly above over here, because this area here is a pretty big resistance area with all of the Fibonacci levels lining up nicely. Okay, I think I have time for one more chart. So if you guys have any requests, feel free to let me know. Okay, let's go ahead and take a look at DXY. Just really quickly, this will be our last one for the day. Okay, so same thing, let's take a look at the weekly time frame. Looks like price is moving downwards on our daily as well. Okay, it's moving in this descending trend line on our daily time frame. Okay, nope, trend line on our 4-hour time frame. So let's just go ahead and add some support and resistance levels. Okay, and then here is my first support. And my second support here. Okay, now let's go in with our Fibonacci levels. Okay, my 78.6 lines up. And let's go in with a projection. Okay, for projection, we use these 3 levels. So I'm just going to check. Okay, and price has surpassed our 61.8, so this is no longer valid even though it lines up with our first support, but our 100% lines up with our first resistance. So I'll be keeping that as well. Okay, so this is a significant area for us to take note of. Okay, I think that's it. So let's take a look at our indicators. Price is moving above the Ichimoku cloud. It's also giving us bullish on our MACD. Okay, RSI isn't really telling us much here. Okay, no. Okay. Let's maybe take a look at stochastic as well. Okay, stochastic is pretty bullish as well. Okay, so we can expect price to continue upwards and be attracted to our first resistance since there is such a major confluence area here. But we can also maybe expect it to reverse off and hit back down to our first support. So, but as of right now, it will be attracted to the first resistance, but it's not likely to pass such a large resistance area. Okay, that's all I have for you guys today. Let me know if you guys have any other questions. If not, I'll see you guys next week. I hope you guys found it helpful, and yeah, I'll see you guys next week and have a great rest of your week. Bye, guys. Bye. Thank you.